The New York Stock Exchange just used its platform in front of the biggest gathering of institutional finance people in Europe to tell the world that Ripple is the infrastructure model for the future of money, not Bitcoin, not Ethereum, Ripple. And if you think that's just a random sponsorship pick, I need you to stay with me for the next few minutes. Because when I connected what the NYSE did this week with three other specific things that happened quietly in the background, something clicked into place. And I think most people watching XRP charts right now are completely missing it. A one-word change in a company bio, a $44 trillion exchange posting a video, a Hong Kong financial research paper, and 926 million XRP that are now locked in ETF structures and not coming back to the open market. Four signals, 1 week. Let's talk about what they actually mean. Welcome back. Today, we are not talking about price. We're talking about the structural story underneath the price. And I promise you, by the end of this, you'll be looking at this week's news in a completely different way. No predictions, no targets, just the logic and the data. Let's go. Let's start with something small that I think is actually large. Ripple changed one word in their public bio this week. For years, it read, "We're building the Internet of Value." Now it reads, "We're enabling the Internet of Value." Building, enabling. One word. I know how that sounds. I know some of you are rolling your eyes. But let me tell you why I think this is not a nothing move. Companies the size of Ripple don't change their public-facing positioning randomly. There are communications teams, brand guidelines, legal sign-off loops. A bio update at an enterprise-grade company is a deliberate signal. It gets discussed in rooms you and I are not in, and they chose to make it now. So think about what the words actually mean. Building means you're in construction. You're laying foundations. You're mid-project. Enabling means the infrastructure exists. You are now the utility company. You're the one who flips the switch for the people who need the lights on. Ripple spent 14 years building 75 regulatory licenses globally. They absorbed Hidden Road, which gives them prime brokerage. They absorbed G Treasury, which gives them treasury management infrastructure. Their current product stack is custody, payments, stablecoins, tokenization, prime brokerage, and treasury, all under one roof, regulated in Luxembourg under the CSSF, regulated in the UK under the FCA, and licensed across dozens of other jurisdictions. That is not a startup description. That is a company that has finished construction and is now selling the rails. We're enabling is not marketing. It's a positioning statement aimed at enterprise clients. It says, the build phase is over. The deployment phase has begun. And historically, when Ripple has made this kind of language shift, something followed shortly after. Not always the next day, but something followed. I don't know what it is. Could be a major bank going live on their ODL network. Could be a tokenization partnership announcement. Could be something we have no visibility on yet. But that language doesn't shift without a reason. And it shifted the same week that the New York Stock Exchange decided to feature them in front of every institutional money manager in Europe. Now I want to show you a number that I think tells the real story of where XRP stands right now, and it's not the price. 926 million XRP. That's how much is currently locked inside US spot ETF structures. We are 74 million away from a billion XRP locked in ETFs. Now let me explain why that matters. The total fixed supply of XRP is 100 billion, never going up. The circulating supply is roughly 55 to 57 billion. Of that, a portion sits on exchanges where it can be bought and sold immediately. Every time $1 million flows into an XRP ETF, the fund goes out and buys XRP. And then that XRP goes into cold storage custody. It stops trading. It stops being available to the open market. ETF holders are not day traders, flipping on a 5% move. These are retirement accounts, pension allocations, institutional balance sheets with 3 to 5 year holding mandates. That XRP is not coming back to the order book next Tuesday. Now look at the flow data from this week. Net ETF inflows for XRP, positive 10 million. Total monthly net inflow for June, positive 23 million. May was 131 million. Bitcoin ETFs this week had 226 million in net outflows. Ethereum ETFs lost 10 million, and XRP, with the price sitting around $1.14, was still pulling money in. Let me say that again differently. The price went down. The institutional buying kept going. That is not retail behavior. Retail panics when price drops. Institutional buyers with a thesis use the dip as a cheaper entry. Now add the real-world asset layer. About 18 months ago, total tokenized real-world assets on the XRP ledger were around $50 million. Today, that number is approaching $5 billion, 100 times growth in a year and a half. And the projection from people tracking this closely is that the next move is from 5 billion to 500 billion. Think about what that actually requires. Every transaction on the XRPL, every swap, every settlement of an illiquid currency pair needs a bridge asset to make it work efficiently. XRP was specifically designed to be that bridge. It's fast, it's cheap on a per transaction basis, and it's already integrated into the infrastructure. You don't need to be an XRP maximalist to understand that 100 times growth in RWA tokenization on a ledger where XRP is the native bridge asset creates structural demand that is independent of any short-term price chart. The math is not complex. Fixed supply, expanding use cases, institutional buyers not selling. ETF structures pulling tokens out of circulation every single day. Those four things point in one direction, and that direction is not sideways. Now let's talk about what the NYSE actually did, because I want to make sure we're treating this with the weight it deserves. The New York Stock Exchange listed market capitalization is somewhere north of $44 trillion. Probably closer to 50 trillion now, given where equities are right now. When they show up at Money 2020 Europe, one of the most watched fintech conferences on the planet, and choose Ripple to be the company featured in a video about where digital asset infrastructure is heading, they are not doing that casually. This is not a tweet. This is not a paid newsletter mention. The NYSE selected Ripple as the example of what institutional-grade digital asset infrastructure looks like. Cassie Craddock, Ripple's head of Europe, broke down the full stack on camera. Custody, payments, stablecoins, tokenization, prime brokerage, treasury management, all in one regulated infrastructure. For banks and financial institutions. She didn't say for crypto enthusiasts. She didn't say for retail. She said banks and financial institutions. And here is the connection that almost nobody is drawing right now. One of the NYSE's own strategic initiatives, an initiative they announced and are actively building, is a partnership with Securitize to create a 24/7 tokenized securities platform. That's a real thing the NYSE is building. Now, Securitize is also in the process of integrating with the XRP ledger to expand access to tokenized assets in their ecosystem. Both of those things are publicly documented. So the NYSE is building tokenized securities rails. Their tokenization partner is integrating with XRPL. And then the NYSE turns around and puts Ripple on camera as the benchmark for digital asset infrastructure. You can call that indirect. But it's not a coincidence. The NYSE's fingerprints are on the XRP ledger's institutional ecosystem in a way that almost no one is connecting out loud. Then there's Hong Kong. The Hong Kong Institute for Monetary Research, which is affiliated with the Hong Kong Monetary Authority, just published an academic working paper on token-embedded platforms in the digital economy. They picked 3 case studies, Omisco on Ethereum, and Ripple and XRP specifically for cross-border payments. Their explicit finding, using the Ripple network with XRP is cheaper and faster for international settlements compared to traditional payment rails. This is not a YouTube channel saying that. This is an academic paper from a financial research institute connected to a G20 central banking authority, putting it in formal policy language for regulators and lawmakers to read. Same week, NYSE feature, Hong Kong academic validation. These are not the things that happen to companies who are losing. These are the things that happen to companies who are winning in the rooms that matter. I want to be straight with you about where we sit right now, because I think a realistic view actually makes the thesis stronger, not weaker. The Digital Asset Market Structure Clarity Act is in trouble. A month ago, markets were pricing in roughly a 70% chance this gets passed in the current session. That number has dropped. It's sitting below 50% now, somewhere around 45 or 46%. There are emergency legislative meetings happening. The timeline has slipped, and you can see that in the price. XRP is at $1.14 as of when I recorded this. We tested $1.28 to $1.30 resistance and couldn't hold above it. If we lose $1.10, the next logical support area is around a dollar. June has historically been a rough month for XRP. The data backs that up. I'm telling you that because it's true, and I'd rather give you the honest picture than pretend none of it is happening. But here's where I think the interpretation gets interesting. Even if the Clarity Act fails this session, nothing Ripple built unwinds. The 75 licenses don't get revoked. The Hidden Road acquisition doesn't disappear. The securitized integration with XRPL doesn't stop. The Hong Kong research paper doesn't get retracted. The NYSE video doesn't get deleted. Regulatory clarity speeds up institutional adoption. It doesn't create the infrastructure. Ripple has been operating, expanding, and signing enterprise contracts in the absence of U.S. regulatory clarity for years. A Clarity Act passage would remove a speed bump. The road itself already exists. The catalysts I'm actually watching over the next 60 to 90 days are not in Washington. They're operational. When a company that has been saying we're building for 14 years publicly shifts to we're enabling, the next move is usually a product going live or a partnership going public. Something is coming. I don't know exactly what. But I've been watching this space long enough to know that kind of language doesn't change without a reason behind it. Let me give you the quiet number one more time because I want it to sink in. 926 million XRP is locked in US spot ETF structures. We're 74 million away from a billion. And that number goes up every week that institutions are net positive on inflows, which has been most weeks since launch. Every token that goes into an ETF custody structure is not sitting on Coinbase waiting for the next news cycle to sell it. These tokens go into multi-signature institutional vaults. They don't come back out for a 10% gain. They come out when an institution with a 3-year mandate decides to exit. And right now, that population of institutions is still adding, not exiting. Exchange reserves for XRP have been declining over the past year. Slowly, not dramatically, but consistently and in one direction. Supply leaving exchanges means less immediate sell pressure. It also means that when demand picks back up, the available float is smaller than it's been. The total supply is fixed at 100 billion XRP. That never changes. But the effective liquid supply, the portion actually available to trade on open markets right now, is shrinking. Not because of hype, because of structural buying from products that don't sell on volatility. I know it's not fun to be in a period where the price is sideways to down while you're watching the news pile up and nothing seems to respond to it. That is a genuinely frustrating experience, and I'm not going to pretend otherwise. But here's what I've learned from watching market cycles over time. Being early feels exactly like being wrong. The two are almost indistinguishable emotionally. The difference only becomes clear in retrospect, and by then, most people who got shaken out have already left. The signals I look at are not the price. Is institutional buying continuing? Yes. Are ETF outflows happening? No. They're net positive. Is Ripple expanding its regulatory footprint? They just acquired Hidden Road and G Treasury. Are major institutional actors acknowledging XRP and Ripple's infrastructure? NYSE said yes this week. Is academic and policy legitimacy building? Hong Kong said yes this week. Every single one of those signals is pointing in the same direction while the price chart is going sideways. That's not a contradiction. That's what accumulation phases look like. The retail crowd sees a flat or down price and concludes the story is over. The institutional layer sees a flat or down price and concludes it's a window that's still open. I genuinely don't know when this resolves into price discovery. Anyone who gives you a specific date and a specific target is selling you something, but I do know that the structural picture right now does not match the price chart. And when those two things diverge, history is pretty consistent about which one corrects toward the other. The question is not whether XRP has a structural case. The question is whether you're still holding when the structural case becomes obvious to everyone who's currently ignoring it. Let me leave you with the one thing I want you to take away from everything we covered today. The New York Stock Exchange does not advertise for charities. It does not spend resources promoting companies out of goodwill or because someone's intern thought it would be a nice touch. When the NYSE puts a company on camera at the biggest institutional fintech conference in Europe and calls them the gold standard for digital asset infrastructure, they are broadcasting something to every bank, every custodian, and every asset manager in that room. Ripple went from fighting the SEC in a courtroom to being featured by the NYSE in a showcase about the future of finance in under 2 years. That's not a coincidence. That's not luck. That's 14 years of building something that the largest financial institutions on earth are now ready to plug into. And right now, while the price is sideways, while retail is losing patience, while the news cycle is slow, the ETFs are still buying, the ledger is still growing, the academic papers are getting written, and the NYSE just told the world who they think is building the financial internet that comes next. Comment below. What do you think the bio change from building to enabling actually signals? I have a specific theory and I want to see who else is tracking it. If this kind of analysis is what you're looking for, this is what this channel does. No noise, no hype, just the structure. The NYSE doesn't advertise for charities, it advertises for partners. And this week it advertised Ripple. Sit with that.